Well, welcome to the Financial Accounting Review for Accounting 283, which is the managerial accounting here at Southwestern. My name is Patrick Lee, and I'm going to go through the accounting equation and the debits and the credits, which is kind of a review for our managerial course. So the first question that we've got to ask ourselves is, why is the accounting equation so important? And here's why. It creates a foundation of the accounting principles that we have learned and we will learn in managerial accounting. Everything starts and ends with the accounting equation. It is used in every transaction or event that we do in accounting. So we might talk a little bit about purchasing a building, and that transaction is going to have an important part in the accounting equation. So it will be used in that transaction from a bookkeeping standpoint. And finally, auditors and tax agencies rely on the accounting equation. So they like to look at the accounting equation to make sure it balances. So what's this accounting equation? Well, if you remember, our accounting equation is assets equal liabilities plus owner's equity. The way that I usually put this on the board is A equals L plus OE. So I will abbreviate this. You'll also see this on the lower right-hand corner of some of these slides. So the next question will be, what is an asset? So an asset is an economic resource owned by the business that are expected to benefit future operations. So it is a resource that the business owns outright. And when I mean outright, I don't mean that there's no loan attached to it. I'm just saying that they own it. They technically have title to it. And they are expected to get a benefit from it in the future. Okay? So here are some examples of assets. We've got cash, because those are typically owned by the business that could benefit the business in the future. We've got money owed to the company by customers, so we call that accounts receivable. Remember, if customers owe you, you still eventually hope to receive that money, and once you receive that money, then you can use that money. Another example of assets are land. So we expect that maybe they're going to build a building on top of that land. Interesting story. The Rose Bowl will happen by the time you watch this. And one of the companies that supplies items to the Rose Bowl for the BCS National Championship is the grass. Out in Indio, California, they grow the grass, they cut the grass there, and they transplant that grass from Indio all the way to Pasadena, California, where it's installed onto the turf onto the floor before the BCS National Championship. So that's an instance where land is an asset to the grass company. They need that land to grow the grass that will eventually show up on your TV screen when you watch the National Championship. Buildings, obviously, for manufacturing, and inventory. Okay, so those are examples of assets. Those are assets. So when we say debit an asset, we might say debit cash, debit land, debit building, debit inventory. All right, so we're going to move on to liabilities. Liabilities are obligations of a business to pay cash, transfer assets, or provide services to other entities in the future. Okay, so let's break this down a little bit. We've got pay cash. So that is an accounts payable. Okay, we want to pay that cash. Maybe we need to transfer some assets, so we owe assets to someone else. For instance, if a customer prepays us, they're expecting to get something in return. Maybe that is, in the case of a Boeing 737, Southwest Airlines might pay Boeing in advance of receiving the asset. And what is that asset? A Boeing 737. Or providing a service. So for instance, you guys prepaid Southwestern College, which means that you have given X amount of dollars to Southwestern College for your education in the spring semester. That money is already in Southwestern's pocket. Now we have to deliver on that, which is providing the service to you. Okay. Examples of liabilities are debts to other businesses, amounts owed to suppliers for goods or services, which we call accounts payable, and loans from the bank or credit cards. Okay, so those are liabilities, things that we owe. And finally, owner's equity. Owner's equity represents claims by the owners to the assets of the business. So I like to think about this as we have these assets. They're either bought with liabilities or they are bought with owner's money or owner's claim to those assets. Okay, so examples of owner's equity would be residual interest. We call that retained earnings. Equity in the business, which is money that a business owner puts into their business or a shareholder puts into a business. Okay, and then finally, stock repurchase but not retire. We call that treasury stock. What that means is, let's say if I was a public company like Walmart, I've got millions of shares out there, and let's say Walmart wants to buy back some of those shares. Well, they can't be an owner of their own stock, technically speaking. So what they'll do is they will repurchase their stock and hold it, and they will use it for things like maybe they're going to give that stock to their employees, or maybe it's going to be a stock option to their executives. That's what we call treasury stock. Now, the owner's equity equation can be also expressed in another equation, and we call that the owner's equity equation. And we express that in the following way. Owner's equity equals owner's capitals plus revenues minus expenses minus dividends. So when we talk about owner's equity, okay, down here on the right-hand side here, you see owner's equity. When we talk about owner's equity, what we're really talking about is owner's capital plus money that's come in from revenues minus expenses, because we have to pay those expenses, minus dividends. Dividends is what we return to shareholders for their interest in the business. Okay? Now, if you remember from my class as well as in math, we've got two equations. We've got the equation down on the right-hand corner, which is assets equals liabilities plus owner's equity, and then we have the middle equation, owner's equity equals owner's capital plus revenues minus expenses minus dividends. What we can do is combine it. So if we combine it, it might look something like this. We have assets equals liabilities. Instead of owner's equity, we're going to throw in that equation. We're going to replace that equation. So we get owner's capital plus revenues minus expenses minus dividends. Now the problem with this is we all hate negatives. So what we're going to do is we're going to take the expenses to dividends. We're going to subtract it. We're going to add it to both sides, and we eventually get assets plus expenses plus dividends equals liabilities plus owner's equity plus, owner's capital plus revenues. Okay? So that's the equation you need to know. That's the equation that we'll always use. That's the equation we'll be using in managerial accounting, and that's the equation you've used in financial. So when we talk about these accounts, these are what I like to call classes. So we have the asset class, the expense class, the dividends class, the liabilities class, owner's capital, and revenue. Below those classes, we have our accounts. So when I talked about accounts, assets, we talked about cash and inventory. Cash and inventory are assets. They are part of the assets class. When we talk about expenses, we have payroll expense and rent. When we talk about dividends, we really just have dividends. When we talk about liabilities, we have credit cards and loans. So remember, those are our accounts. The liability is our class. That is not an account. For owner's capital, we have capital stock and additional paid-in capital. Capital stock is money that comes into the business originally. Additional paid-in capital is what comes in afterwards. So you start a business, you put $100,000. 5 years later, you need to put another 10 grand. That 10 grand is the additional paid-in capital. And then revenues, depending on what industry you're in, it could be called sales or shipping revenues. So for UPS, it might be shipping revenues. For Walmart, it might be sales. So in accounting, we have something called the double entry accounting system. And what this is a basic method of recording and reporting a business's transactions and events. The reason why we use this double entry accounting system is because of the principle of duality. Every economic event has two aspects. You're giving something up to get something in return. So if you put some effort, you might get some rewards. If you sacrifice something, you might have a benefit at the end. If you source something, you want to use it. So there is a principle of duality, and that's why we use this so-called double entry accounting system. So in double accounting system, we have something called debits and credits. Okay? We will always have debits and credits. Now, if you haven't remembered or maybe you forgot, a debit is an accounting term for left. That is it. It has no correlation to decrease, reductions, or less. So when you go to the bank and they say, well, we'll debit your account, that means you'll have less money in your account. But that's not what we mean in accounting. So you can throw out the idea of debit meaning less out the window, out the door when you walk into the class. Okay? So from a T account perspective, And remember, this is a T account. It looks like a T. We have the left side and we have the right side. And where it says T account, we'll put the account's name. So it could say cash, or it could say accounts payable, or accounts receivable. So on the left side, we have debit, left. Okay? Credit, on the other hand, would be right. It has no correlation to increases, grow, or more. And so, for instance, if we draw our T account, this right side is the credit side. Okay? So left side's debit, right side's credit. That's all they mean. So in my class, debit's left, credit's right, done deal. All right, debits and credits. So why is this important? Accounting uses different accounts which will make an account go up, but not necessarily be a credit, but rather a debit and vice versa. So there are different accounts, and some go up and some go down. But some accounts might go up and we might debit them. Some accounts might go up and we might debit them as credit them. So throw out the window the idea of debits and credits meaning up or down. Debits truly only means left, credits truly only means right. So let's review. Debits are left, credits are right. Left means debit, right means credit. Now it's your turn. So take a moment and see if you can identify these. I hope this is super easy for you. But we have debit. So what does debit stand for? That would be left. What about credit? That would be right. And I don't mean correct as in right, I mean just right. What about debit? That would be left. And if I said left, that would be debit. Pick up the speed here. Credit is right. Right would be credit. Debit would be left. Okay, so whatever you've learned about debits and credits, debits only mean left, credits only mean right. All right, when we apply debits and credits, we must always have a debit and always have a credit. So if that's one thing that you'll learn, we must always have a debit and we must always have a credit. Now we can have more than one debit and only one credit, and we can have more than one credit but only one debit. But you must have debits and credits. They must equal each other. Okay? So let's take a look at our accounting equation. Assets plus expenses plus dividends equals liabilities plus owner's capital plus revenues. Okay? Increase it. So let's talk about the first part, which is the left side, the assets, expenses, and dividends. If the account on the asset, expense, or dividend side increases, we will debit that account. If it decreases, we will credit that account. Okay? So if this is a cash account, a rent account, or even a dividend, if the dividend goes up, the amount of cash that the company received goes up, the amount of rent that we have to pay goes up, we will debit that account. If the amount of cash out of our pocket goes down, the amount of rent goes down, which it would never go down, FYI, and dividends will never go down. But if those were to go down, we will credit. And typically this will happen on the assets, expenses. We will always most likely debit those accounts. We'll never credit them. On the far right, liabilities, owner's capital, and revenue, such as credit cards and loans, capital, stock, and APIC, and sales and revenues, if they increase, we will credit that account. So for instance, if the amount of debt on my credit cards increase, we will credit that. Okay? Notice that's very different from the left side. If the amount of money I put into my company increases, we will credit that account. If I have more sales, okay, so I sold another piece of equipment today, that means it's a credit, more, okay, increases on that side. If the amount of my liabilities go down, so let's say I start to pay my credit cards, I'm going to have a decrease, so I'm going to debit that side, okay. So if it's on the left side, assets, expense, or dividends, and it increases, I want you to debit that account. If it decreases, I want you to credit that account. On the far right side, if it's a liability, owner's equity, or revenue, if it increases, I want you to credit that account. If it decreases, I want you to debit that account. So let me give you some examples here. Jim receives $20,000 in cash. So what happens? He's getting more cash, so cash is going up. So if this was the cash account, I'm going to debit because this left side, I'm going to increase. If it increases, I'm going to debit. If it decreases, I'm going to credit. Okay? So the amount of cash that Jim receives is $20,000. That means he received it. It went up. So I'm going to debit $20,000 because that means it went up. At the end of the week, he gives $5,000 away. Now, we don't really care at this point. We don't care why he gave it away, but we gave it away, which means the amount of cash went down. If it went down, it decreases. So if it decreases, we are going to credit that account, $5,000. Decrease. Okay. Typically, we total the bottoms up, and then using a left to right or right to left, we will subtract the smaller one from the bigger one, and whatever's left stays on the bigger side. So the 5,000 is the smaller side, 20,000 is the bigger side. We'll subtract the 5 from the 20, and we would get 15. That's our balance, a debit balance of 15. All right, let's take a look at the opposite side, liabilities, owner's capital, and revenues. Remember that if it increases, we're going to credit. If it decreases, we're going to debit. Southwestern College receives $25,000 in tuition revenue today. So they had sales of $25,000. Sales went up. So tuition revenue went up. It's a revenue account. We are going to credit. Okay. Why are we going to credit? Because the amount of tuition revenue, now we're talking about cash here, just the revenue went up by $25,000. After a few days, the college experienced a few drops in classes and had to refund $10,000 in tuition revenues. So the tuition revenues went down. Now, we do have a sales return account that we can talk about, but for this problem only, the sales have to come down. So if the sales come down by $10,000, it decreases. Tuition revenue is a revenue account, so we are going to debit the left side, remember, by $10,000. We sum those up, we get $10,000 left, $25,000 on the right. We take the smaller amount, we subtract it to the bigger amount, and whatever's left stays on the bigger side. So we get a balance of $15,000 as a credit. Okay. So we're going to give you another more comprehensive example here. Target sells the newest iPod in their store for $195. John, a customer, comes into the store to purchase the newest iPod for his son's birthday. At the checkout, he gives the checker $195 in cash, and Target gives him the iPad. What are the debits and credit entries Target is going to post in their books? Disregard the inventory and cost of goods sold for this transaction. If you remember, this requires two transactions. One for the sale, one for the inventory going out. We're going to ignore the inventory going out. Okay? So, what happened? Target receives $195. Target also made a sale for $195. Okay? So they received $195. They also made a sale for $195. So if we bring up two of our accounts that we're going to use, which is cash and sales, we're going to work with cash first. Cash went up. It is an asset. Therefore, we are going to debit the account. Target made a sale for $195. That is a revenue account. That side we're going to increase, which means we're going to credit that account. Okay, so if Target receives the money, it's going to receive the money, $195. That increases the cash account. The cash is an asset. Therefore, we are going to debit. Target made a sale as well, because that's how they got the money. Therefore, we need to increase the revenue account. The revenue is a revenue account. Therefore, if that increases, a revenue we are going to credit for $195. Now, journalizing these entries. Now, these T accounts are great and all, but the problem is if we actually had to put all these dang T accounts on a piece of paper, we would have bunches and bunches of paper. So we use something called a general journal, where we journalize all of our journal transactions. And so, for instance, in this case, we had a debit of cash of $195 and a credit sales or revenues for $195. The way that we journalize this is located below. We have the date, we have the debit, we have the credit, we have the amounts, and we have the reason. Now, typically I would have students put the transaction numbers, but for this case in point, we're not going to do transaction numbers considering what we're reviewing. When you write the debits and the credits in a journalized fashion, to the far left, you are going to put the date, and then you're going to debit on the far left, okay? You're going to put the amount on the left-hand box, and the right-hand box you're going to leave completely empty. When we do the credit, you must give it space, okay? Space. Give it space, and then put the account name, skip the first box, and put $195 in the second box. That's your credit box. So the third column of boxes is your debits. Your fourth column is your credits. Okay, so that's how we generalize our transactions. All right, finally, the accounting equation is a fundamental part of accounting and transaction reporting. Remember that debits are left and credits are right. Nothing else, nothing more. So forget everything your banker has told you. We use this equation always in my class. Assets plus expenses plus dividends equals liabilities plus owner's equity plus revenue. Okay. The left side of the equation, so if it's an asset, expense, or dividends, we're going to debit if it increases, credit if it decreases. So if it increases debit, decreases credit. On the liability, owner's equity, or revenue side, so the right side of the equation, if it increases, we are going to credit those accounts. If it decreases, we are going to debit. Okay? That is your financial accounting review.